Imagine millions of Americans being forced to buy a single stock, not because they researched it, not because they chose it, but because a financial system quietly moved their money for them. Right now, SpaceX is preparing for one of the largest initial public offerings in the history of the stock market. The projected valuation sits at nearly $1.75 trillion. To put that in perspective, that single number is larger than the entire economic output of most nations. For years, the public has viewed SpaceX through a lens of engineering triumphs. They developed rockets capable of landing and flying again, which drastically cut the price of reaching orbit and changed the logistics of spaceflight. That technological success fuels a much larger narrative. The company actively sells a multi-decade vision of expanding human presence across the solar system. But behind the excitement, investors face a mechanical reality. Are they buying into a financially sound enterprise at that price? Or are they walking blind into a carefully structured trap? Because beneath the spectacular engineering of space exploration lies a completely different kind of machinery, a financial plumbing system that, by design, could systematically extract wealth from everyday citizens. Corporate leadership has successfully presented SpaceX as a single, unstoppable monolith, but looking past the presentations reveals a fractured internal reality. The company does not have a unified business model. It is actually three entirely separate operations, each with drastically different financial health, all operating under the exact same brand name. The first division is satellite internet. By providing access to millions of global subscribers, it generates enormous revenue and acts as the financial anchor. The second division handles the rocket launches. While highly visible, the massive infrastructure, engineering, and fuel costs required to send payloads into orbit keep this operation close to a break-even margin. It survives, but it doesn't print cash. This chart reveals the third division, artificial intelligence and experimental deep space technology. It operates at an extreme deficit, requiring endless capital. These projects drain the satellite network's profits, immediately consuming the healthy cash flow from the other side of the business. Yet the broader market eagerly accepts the $1.75 trillion price tag, ignoring the massive internal drag. That towering valuation does not reflect stable profitability. Instead, new investor capital is required to constantly subsidize an enormous, ongoing technological cash burn. So how does an enterprise burning through this much cash maintain a valuation larger than most countries? The answer lies entirely in the mechanics of the modern trading floor. In the past, companies had to prove years of stable profits to be included in major market indexes, but recent structural changes allow exceptionally large corporations to bypass those traditional hurdles and fast-track their entry into crucial benchmarks. Once added to an index, it triggers automatic buying pressure. A hard-coded signal forces passive funds to purchase the stock, bypassing balance sheet analysis. The capital powering these funds is pulled directly from the combined life savings of ordinary civilian retirement accounts. This creates a constant mechanical flow of money. The individual contributors never research the company or explicitly approve the transaction. The rules demand the purchase, and the funds comply. This mandatory influx of cash pushes the stock price upward, creating a momentum cycle that is completely disconnected from the actual financial fundamentals of the underlying business. The modern market structure has created a trap. It artificially props up extreme valuations, using civilian retirement money as unquestioning price support. In any public offering, every transaction requires two sides. If billions of dollars from passive funds are suddenly forced to buy, someone else has to be selling. Those sellers are the early investors, venture capital firms, and company executives who secured their shares years ago, often for pennies on the dollar. This diagram outlines a dynamic known in the financial world as exit liquidity. Early insiders rely entirely on a massive influx of new retail capital to convert their paper wealth into real cash. Once that exchange happens, the risk transfers completely. Insiders walk away with the cash, and passive buyers carry the weight if excitement fades. In this context, the grand promises of interplanetary colonization and artificial intelligence serve a highly functional purpose. They act as the necessary marketing material to justify an astronomical IPO price to the broader market. Developing revolutionary technology and building a great company is a difficult achievement, but securing a return on investment relies far more on perfectly timing the market mechanics. The vision of human life on Mars is an inspiring narrative, but in a financial context, it acts as a mechanism to offload overvalued shares onto passive index funds, allowing early insiders to walk away with the cash.